I'm literally right now seriously considering like 10 to 15 investments at once. So really I don't know which one to pick, but in the spirit of keeping it, I guess, at real estate, non-owner occupied or non-tenant, is that the best thing to do?
Yeah, I was actually going to maybe recommend Wilmington.
No, that's tenant. So
Okay.
I'll use a different one.
Okay.
Right now I helped the structure invested a few months ago in a very small fund, about $435,000. It was a pooled notes. We actually originated a pooled notes. Instead of buying notes, we originated notes to someone who owned pooled homes at roughly about a 58% loan to value. This is actually out of state. Most of my investing is out of state. In fact, all of it's ever been out of state just because of the cash flow levels. Typically, you can get higher cash flow. We basically did 5-year notes, 58% loan to value, 11% interest only, and we also share in 35% of the profit when the homes are resold. And the homes are scheduled to be resold between years 3 and 5. It's kind of an unusual deal because usually you get the interest, but you won't necessarily get the back end fee. So it's actually a particularly good structure. So I'm flying out there at the end of the month, looking at what we got, looking at possibly a small fund too. That's one example.
Mm-hmm.
I'm looking at a bunch of hard money deals just for flips. Is there a question?
Yeah, I was just going to say, I think the syndicator is going to be here at the next speaker.
Yeah.
Yeah.
Oh, yeah. True Wholesale House is who we invested with, TWH. Yeah, I think he's one of the panelists next time.
Yeah, and in March, Jay Heinrichs is the guy who is the operator that this
Yeah.
note was put together with.
And then the deal that Dave was referring to is a specialized short-term rental apartments, local actually, where the cash flow 10-year average is projected to be about 11%, but that's actually free and clear with no loan. So if we're able to actually finance in the first year, which we project, the leverage would actually bring us up to about a 15% cash-on-cash annualized return, and we'd be able to cash out about 55% of our investment right up front. So what I like about that deal, which is really unusual, especially since it's local, is that even if we don't get the loan, which is really key, if you don't get the loan, the cash flow still works. And if you get the loan, it's an even better deal. So that's a 46-unit building, local. That's another example. But that's actually tenant-based, though. So
Yeah, that's all right.
yeah.
But the structure is unusual, that you're not just buying the building.
Yeah.
You're buying into a fund that's buying the building.
Yeah, that's typical syndication. You're a piece of a deal. Someone's managing it who understands that type of asset. They have a lot of experience. And but to David's point, the way the deal's structured is important too, in terms of the investors having a preferred return for themselves, et cetera. So.
This is going to be the fun one. I'm going to leave it on you, Jeremy, to start. Let these two think for a second.
Was it on the list?
Yes, on the list. What was the biggest mistake you've made as an investor, and how has it changed your system or processes?
I would say, I was thinking about that one actually, and it's a tough question. Can one of them answer first?
Yeah.
What's that? What was your answer?
I said, you don't make any mistakes.
That is not true, and I mean, it's impossible to bat 1,000. It really is. I mean, you can do your best. You have to be realistic, which is why personally I invested over so many different things. So let me answer it this way. I'm a much better investor than I was when I first started, and what I mean by that is that I'm much better at understanding how to mitigate risk, how to structure things to mitigate risk, how to understand what the risks truly are, and I can read an opportunity in a pro forma projections 20,000 times better than I could at the beginning. So the lesson for me was slow and steady, which is exactly what I did. It took me a long time to ramp up, but it really paid off because I minimized my errors. For anyone looking to invest the way I do, I think that's absolutely critical. And that's why I say opportunity exposure in what I do is absolutely the number one thing you can do. And I always tell people you got to start slow, just go slow and steady. I even say you can read deals for 2-3 years if you want before you invest, so you really understand what you're getting into.
Now my question is, while you're reading and studying, did you ever try to implement any piece of it in like a vicious way or
What do you mean by that?
like you reading and studying of what you want your business to be?
Right.
Did you ever go out in the middle of your study and actually do something related to your study? Or did you wait until you had all the pieces, or like analysis paralysis?
So, okay, right. So I can't remember, to be honest, how long it took me to really ramp, but I do remember I started actually exactly 10 years ago this month, and that's when I made my first investment. And I had an advantage because I invested the first time. It was actually in Canada, so I had a currency risk. I'm from Montreal originally, so I understand that market. But I invested in a lifelong friends of my family, and I basically trusted them. So that's when I understood the deal structures least, and I knew they were really conservative just because I knew them. But I still took a little bit. I took a small dip, and I took a second dip with them, and a third dip with them, I believe, before I even invested with anybody else. And that probably took 2 years, 3 years, I'm guessing. So, I mean, analysis paralysis, I know that could be a big problem, but it depends on what your strategy is and your horizon is. For me, it was like a slow and steady rollover to be cautious. But I actually ended up doing things, which is really key too. I mean,
Especially with your mentors, kind of.
yeah, and I will say that I think it's better to invest in a very small deal and learn from it and to have made a mistake than to just sit back, say, for 4 or 5 years, gone to a bunch of courses, but never actually invested, in my opinion. Because
It becomes obsolete.
yeah, and exactly. Strategies change. Your learning will be different once you invest in a deal. You'll be much more invested in it. You'll track it more. You'll see how it progresses. You'll learn a lot more from it. That being said, anybody who knows me will tell you that if I talk to somebody new, the first thing I tell them is just go really slow and steady. I mean, really, really slow. It's not worth rushing to get into, in my opinion.
With that analysis paralysis thing, I mean, there's a lot of people that will sell you the education courses and all that fun stuff, but at the same time, a lot of the people that sell these high-priced education courses, they make all their money that way. They don't make it in real estate anymore, you know? So trust me, I've done the numbers. It looks amazing. I sell education.
I just want to say, like, I've been wanting to create a course on cash flow and passive cash. I've never heard of anyone ever doing one. So I've been trying to create one now. It's been a year and a half. I got through a part of it last summer. Like, I'm investing and I don't have time to create the course. So I'm very weird. These guys who go around doing tours and stuff, I'm sure some of them provide a good education, but I know firsthand, it's just not possible they're really investing full time and giving these courses. It's just, you know, from a time allocation perspective. So.
Ellis, mistake?
Yes, I made a few. I would have to say, if I could see a common thread, it was not understanding structure when I gave up too much control over a deal. And I'll give you an illustration. I invested with an apartment operator many, many years ago because I figured that he knew it better than I did because I was just getting started in commercial. Well, at that time, it was the market that really drove the deal, not so much his expertise. So what happens is you make a ton of money on that first deal and you're like, let's just roll it over to the next one, baby, right? You're not really paying attention to the next deal. So luckily I was in the next deal and I had 51% of that deal, so I was like the one that was driving that. I was driving decisions because, you know, like I said, I'm kind of a control freak. So that worked out okay. And then the mistake happened. Okay, so I roll it into a third deal. I have a minority position. It's in a time in the market where you don't have appreciation to bail you out. The way that the structure of the agreement is that the person that's supposed to be driving this deal has no incentive to make it work because he's already got his money out. And I was already drunk with the last 2 deals where I made money. Right, so now I'm seeing this thing. So does everybody know what a cash call is? I know there's a couple people here that know what it is. Because if you deal in a bad deal, they're going to say, well, look, we know we wanted to raise $50,000 from you, but you know what? We didn't hit projections. We need you to send in another 5. And then it's another 10. And I'm just like, what the crap is going on here? So I'm livid, right? And I look at this deal and I'm like, you know what? This is dying fast and I got to find an exit. So I figured, well, you know, we could do a condo conversion. That gives us at least a fighting chance to get our money back, right? So thankfully, there was enough smart people that were shareholders where we went that direction, but it was a lot harder than we thought. But funnily enough, the real way that I made money from this deal was I created a note to lend to this deal.
Nice.
And I get paid. So that it worked out okay, but the mistake is that I wasn't paying attention to each deal because I was just like, oh yeah, that's fine.
You're right.
You're right, and what I confused brilliance was really the market. Anybody was making money in that time.
You got hooked on real estate crack.
Exactly, but I wasn't.
Yes.
I wasn't paying attention to the fundamentals. What will make this deal work? What will happen if it doesn't work? What happens? How are the stakeholders? What is their incentive? All the Jeremy's probably got a better checklist.
And actually, I want to make a comment about what you're saying because one of the probably 20 or 30 things I look for in the way the deal's structured is the cash call provision. Because some deals will force a cash call on investors in the passive opportunities. Some deals will make it optional, but then you can get diluted. And some deals will make it optional, but then rather than getting diluted, you can actually end up taking a loan on behalf of the entity. And all three of those have very different consequences on you as an investor.
Right.
So if you would have seen, like, you know, if you would have gone down to the perspective of looking at that and understanding it up front, you may have never done the deal, for example, or you may have even asked them to structure it a different way.
Right.
So,
But the aftermath of this whole thing, I've seen many people that I have known gone bankrupt because the structure was that they took personal liability for that loan that went bad on this commercial property. So say, for instance, and this bothered me too, say that I was a $50,000 investor and this loan is $3 million. Well, on my credit report, it shows that I owe $3 million. And if that loan should ever go bad, they look for assets. They don't care that you only had $50,000 in this
Yeah.
deal. They go for whoever has assets. And I was, I don't
Going
know what I'm
crazy.
sweating.
Yeah.
Sweating bricks.
Yeah.
Right?
And this deal better work.
Right. So,
And,
yeah.
and you know, that's something I see a lot of investors doing is wanting that deal so bad because they keep wanting to go that you don't realize to look at the, you know, you don't look at the stuff that is really important on the incentive side, or you don't look at your margins well enough and, you know, want to get that deal closed and everything. And I mean, I've done it, you know, in the beginning you're like, I want this deal, I need it, I have to have it for my own confidence level, and then your confidence level gets destroyed, you know.
And I've seen
So,
families destroyed because what they did is they leverage up, leverage up at 1031 because they don't want to pay taxes into the deal that sinks them.
yeah,
That's
yeah,
crazy.
So please don't do that.
yeah. Ginger?
Well, like I said, I teach too, so I see a lot of new people get started. So I'll talk about some of their mistakes first, and I'll talk about my big ones. But what I see, like Matt said, you know, make sure, or actually everybody said, you know, when you're going to a deal, don't get the deal just to get a deal. I met somebody on the phone said, oh, I do short sales, and I get 90% of them accepted. I'm like, wow, you get 90% of your short sales accepted? And I was like, well, send me your deals, I'll look at them. They were all like at 90% of market value.
Yeah, there you
So
go.
I'm like, well, no wonder why you're getting accepted. So don't just get a deal to get a deal. You know, make sure that they're really good. But the thing, so what the mistake that I see from my students that I teach is the analysis paralysis. They'll sit there. So I have a lot of interns in my office. And I'm like, what are you guys doing over there? You've been on that property for like 2 hours. Submit an offer already. You know, so and then I see the ones who make money and just like do it. They have that attitude, like, I'm going to do it, I'm going to get a property next. They have that attitude. But the ones who are not succeeding, they're really scared and very timid. This is not for the timid, that's for sure. To my mistakes, my rehab that I did, actually sold at the beginning of this year, I had partnered with my contractor because I thought, oh yeah, Matt knows. Matt! I had partnered with him, and I thought, well, maybe he's a contractor, but if I partner with him, he'll be incentivized to go quicker and finish the job faster, and that was not the case. And he was doing not a good job, and since he was my partner, I couldn't fire him and get another contractor in to help me. So that was the most difficult deal I've ever done. Right now I have a rehab that I finished. You know, I'm pretty much just breaking even on that one, but I had to do a lot of mitigating to make sure that we're getting all my investors paid off. So all my investors are getting paid off, and so I'm happy. I wish I would have made some money on it, but at least they're paid off. So just little things like that happen, and like Matt said, you know, your ego kind of sometimes gets destroyed, but actually the way I'm looking at it too is like, well, you know what, I lived it, I figured out a way to go work through it, and now I know what not to do next time.
And you can't be successful without taking those hits, because you learn 10 times more in those hits than when you're not. You know what I mean? So
I will tell one story actually that I thought of actually. So in the past 10 years of all the low risk investing I've done, or what I consider low risk, really I've only had 2 things go wrong, which I've been very fortunate about. And just because I'm very slow and steady, and I don't usually invest for appreciation, so I'm investing in a stabilized situation, that type of thing. One of the occasions, which I want to share the story because, you know, when everybody sends me an opportunity or talks to me about an opportunity, whether it's the term guarantee or whether no, I don't care what it is. like Ellis said, Ellis actually made a really important comment before, which I don't know if anybody caught, but he said, my crash and burn is that the house burns down and I have a piece of land, and that's the worst case scenario. I don't care. In most scenarios, somebody sends to me, I can tell them something worse happening they probably think of. And but that's really important, because as an investor, you have to look at the 1% chance, because you have to be comfortable with it if you're going to go into it. So I'll tell you the story of what I call the 2% chance. So basically, I invested in a student housing property. It was about 308 units in Michigan in 2009. And it was with a very experienced multifamily student housing syndicator. And I really like that niche. If you invest, we were like the first property from campus. I mean, we were literally the first property from a state university campus, right? And it was at a time where the economy was bad, and I figured, okay, our rents are probably going to hold. We have the right location, and we're going to get through this slowdown. And student housing is still very strong. So we closed on the property probably in the fall of 2009. Spring of 2010, so campus, bridge, our property. Okay. So, but it's actually worse than that, though, right? So it's actually worse than that. So we have this property that's like 97% or 93% occupied, cash flowing fantastically. And bridge closes, and they're doing the repair. The bridge is really old. It's first time repaired in God knows how many decades. And they're actually saying to us, look, the bridge will be open for the next the fall semester. So people start coming to look at our property in May and June for next year, and they're not liking the bridge, and they're thinking to themselves, well, what if the bridge is closed when I start school? And we weren't in a bad location from the bridge perspective. On the other side of the non-bridge properties are much further from campus. So anyway, long story short, not only was the bridge closed, but it just happened that our loan was actually due that we assumed that summer at the same time. So we had a property that went from like 95% occupied to 65% occupied based on leases. We were in a position where, and it just because if the loan wasn't due, we would have had no problem just making it through a year, breaking even, and then just going out the next year, bridge is open again, right? We had a fantastic property, it's performing really well. Well, bridge closed, couldn't get leased up, loan was due, could not get an extension, which is a whole other story too. And so property ended up being foreclosed, all right? And this happened very quickly. And amazingly though, I told you guys I make a bet on an asset and an operator, okay? So asset failed. We got very lucky. Operator, being the kind of person that he is, actually transferred, or almost finishing now, transferring all the investors from that property to another property with his own equity. Not only that, but he actually was on the hook for the loan as a recourse loan.
Wow.
And so he had to pay God knows how much for that loan to actually pay off the loan, transfer all the investors to another property because he was trying to protect his investors, and we're just about to be finished getting transferred. Now, the transfer's taken a year or two for legal and accounting and all kinds of other stuff, loan forgiveness and all this other stuff. But so that was literally like the 1% chance. And when I invested in our property, I even did not contemplate that the bridge would close and that our loan would be due in the same time. What had happened?
Yeah, I would have bought a ferry boat.
I was thinking a rowboat, maybe.
I charged Jeremy to keep his.
Go build your own bridge.
Yeah.
Right. So, and I like, and it's good to tell that story because it's a good lesson for a couple reasons. One is you have to consider the 1% or 2% and be totally comfortable with it. Because I still look back at that deal, and I still think I still invest in that deal today. Because it was a really good deal.
Can they get private financing or it's just like
Yeah, it was because once you're at the 65% occupancy level and you're having to refinance it, it's a big problem.
Ellis can finance.
You wouldn't like my terms.
Yeah. So, and we didn't want to go negative cash flow. You don't want to do that. That's a whole other. Then you have the cash call, which I've never had that happen to me, but it happened. And so the lesson is you got to consider the 1% risk, and really be honest with yourself about what the risk is. I'm about to invest in this property. We just talked about this multifamily. Not only could there be fire, building burn down, whatever it is, maybe you get insurance, maybe you wait 5 years for an insurance payout, but there's earthquakes. I actually personally know an investor who owned a bunch of apartment buildings in the earthquake in '94, had millions of dollars of assets, lost everything because earthquake insurance is too expensive. I know that when I'm investing in that deal here, which I've never invested in before, but I know that there is a risk that the building could be worth nothing. The land probably, our worst case scenario is that we have to actually pay to get the building torn down, which costs money. And then we have land that may take years to sell. We may maybe get 10 to 20% of our investment back, maybe. But I'm okay with that, But that's the reality. That's the reality of what can happen. So be honest with yourself about what the true worst case scenario is, so you understand that going in.
But it's better than having your money in the stock market with no control either. So
Actually, Jeremy made a really good point, and that's something that we talk about a lot. Jeremy made a bad investment with a good operator. That will turn out better 90% of the time than if you make a good investment with a bad operator. So if you're working with good people, even if you get into a bad deal, a good operator will find a way to get their investors out of it. So, Jeremy talks about you're looking at the asset, you're looking at the operator. I almost think the operator is far more important because you want to make sure you're doing business with good people. So don't just rush, just because it's a great deal, don't rush into it. Make sure you do your due diligence on both sides of that. All right, last question, and then we're going to open it up for you guys for whatever questions you may have. And it involves just with all the economic insanity that's been happening the last few years, what are like the factors that you guys look at specifically when you're tracking your specific types of investments? And I'm going to save you for last, Jeremy, because I know you're complicated.
And I'm very simple. What do I track?
What are the most important pieces of information you keep an eye on
What's
when
the
you're?
collateral worth?
What about from a macroeconomic perspective? Like you're dealing with a lot of real estate.
Yeah. I'm looking at, like I say, real estate is local. So I want to look at what's happening in my farm areas, what's happening, are prices stabilizing, are they going down? I don't buy for appreciation, I'm a cash flow person, so I don't mind if a property goes down as long as I know that rents are stable and what I bought it for can sustain it. I'm becoming more well versed in kind of the macro stuff because I go to Jeremy's meeting where he talks a lot about kind of the macroeconomics. So I'm getting better at that, but I couldn't do justice to his analysis. So I really, I want to keep track of what, how long is it taking for things to sell? What are the rents going out? What's the economic conditions? Are jobs being created? Are big employers leaving from that area? That has a lot to do with who I'm going to,
Where do you get that data from?
Wherever I get it from, it's going to be from a very independent source, not the National Association of Realtors. Because, and I say that lovingly, because they have an agenda, and I respect them for that. They want to get all the realtors hyped up about real estate. Right. But what that does is it gives people bad information to make an investment decision. So wherever you get your information from, one of the best websites I like is called First Tuesday. And they are unbiased. They sift through the real data, and they tell you what the real deal, good, bad, or ugly. And you need to know the truth, right?
Mm-hmm.
So wherever I get it from, you want to consider the source. I like following does everybody know who Bruce Norris is? He's really become kind of an expert in anything real estate. So I follow what he follows, because I'm not that smart to figure it out myself. So I follow Jeremy. I follow Bruce Norris.
And Bruce is going to be speaking at my event
That's awesome.
in Long Beach next month, or in the end
Make
of
sure you go
February.
to that.
You have a flyer? I mean, this
What's the
guy.
date?
He knows his stuff.
February 23rd.
Yeah, Bruce Norris is going to be at our Long Beach meeting that Matt manages. We'll probably have, I'm guessing, 100 people or more. And Matt's got a very big room. If you've never seen Bruce Norris before, if you don't know who I'm talking about and you're looking at single-family investing, ask around in the room just to find out. But he's extremely well respected for his data analysis. He's a great speaker, really good to watch.
Ginger, what about you?
Yeah, same thing, Bruce Norris. And actually from my buyers, I mean, they're in the trenches, they're knowing how long they're holding houses, because most of them will buy like 5 at a time. So in different areas, I just follow up with them and say, well, how's the market, are you selling? And they'll tell me, oh, the market's doing bad over here, or I'm doing really well, I'm holding properties long over here. So actually straight from the horse's mouth, I'm getting that. And then as I'm putting offers into, I'm seeing where the banks are, accepting my offers at right now. So just mostly
On the front lines.
line. Mm-hmm.
Cool.
Jeremy?
My answer is very complicated. My answer is very complicated because I purposely have a strategy to do a certain percentage short-term, a certain percentage medium-term, and a certain percentage long-term. Plus, every time I invest in a different type of asset. So whether it's an ATM and there's certain technologies coming up for mobile payments, or whether it's hard money loans and there's a certain market conditions in certain local areas for single-family flips, or whether it's commercial real estate and there's some loans coming due in 2015 to 2017 that I'm very worried about for liquidity and for pricing resets, for example. I like to tell people in general, the way I like to describe what I'm doing is I kind of feel like I'm steering a really big ship like an oil tanker, and it can't move very quickly because I've got a lot of investments that I've made. And I'm trying to avoid icebergs. And so I really need to look ahead, as far ahead as I can. And so I like to look at a lot of macroeconomic data. And I think the best example I can give is that I literally am steering away from commercial real estate deals that have 5-year loans attached to them. And I haven't really heard too many other people doing this, but because if you look at the data, there is a slew of 10-year mortgages coming due in 2005, 6, and 7. I can tell you honestly, more than 90% are underwater. And that means that there's going to be a lot of foreclosed inventory. There might be a liquidity issue on the banks, and there might be a valuation issue on something you own then. So I cannot wait for 2018 to 2020. That's probably one of the best opportunities I'm ever going to see, I think, in commercial personally. That's just me forecasting. On the flip side, I'm okay investing in a commercial deal today if it's got a 10-year loan, because I'll feel like I'll be steering clear of that potential iceberg of liquidity when we have to go to refinance our loan. So that's a really good example of the kinds of things that I'm personally concerned about. But I'm also very concerned about after the election next year. If I'm making an investment that's like a 2-year investment now versus just an investment that's short-term that might end at the end of the year, I'm concerned about some of the market conditions, taxes, all kinds of stuff. Next year I feel is a really big question mark, and I'm trying to hold off on some stuff until then to see what happens.
Cool. So, there's also some websites you guys can go to. My Budget 360. You said
First Tuesday.
First Tuesday.
John Maudlin.
Patrick.net. You can go to Dr. Housing Bubble's a good one to go to. That talks a lot about the California market. He's really down on it right now, though. So I mean,
He's always down.
yeah, he's always down on it. So calculatedrisk.com, another good one. You guys think of any more?
Well, I just want to make a general statement, though. Another thing I think people really, especially if you're new, just to watch out for, it's clear that we are overall macro kind of nationwide. We're in a deflating asset situation at the moment, which means that prices of housing, for example, are going down, have been coming down. And so, when you're Ellis and you're getting huge discounts, you're basically creating a padding. And Ellis just said to you, he doesn't care if the market value goes down because he's going to hold long term. You have to look at your own strategy and be very careful from that perspective. So personally, if I'm investing, I make sure there's enough cushion. And if you're new, you really need to look into this further and really understand what's going on in the market so you're not buying something that's worth 10 or 20% less next year and you didn't realize it because you were in a market you didn't understand, for example.
Actually, speaking of cushion, so I just started rehabbing, so I'm really careful with the deals I go into because I'm going to need a lot of cushion because I'm still learning rehabbing. So like the deal that I just got stuck on right now, I had a huge cushion. So the market dropped, I spent more than I thought, so that cushion saved me. So always have that cushion there.
And that doesn't mean don't invest in a market like California that's volatile. That just means you have to look at the upside, the downside risk, and make sure you have that cushion available. In the more volatile markets, the more important it is. So, and look at those types of things in detail when you're analyzing each individual investment. Everybody says, each market, in each individual market is independent of a lot of the other ones. There are some macroeconomic factors that affect the whole world, but at the same time, each individual market can outperform or underperform the other ones. So definitely look at those things. That being said, I definitely would like to thank you guys for coming up tonight. Everybody give these guys a round of applause.